Okay, let's look at the journal entries that you actually have to make when you do this whole mess. Now keep in mind that the journal entries, remember we have the easy one here at the top. This is not going to be the source of your journal entries. The source of your journal entries are going to be the adjustments you made to the bank rec that began with, put it right here so you can't see it, that began with the books version of ending cash. Remember, we have that here in the checkbook. 81.96. Not the beginning, the ending. Okay, we made a bunch of adjustments, and we need to make entries. We need to make journal entries for these entries. We can't just take it for granted. The whole purpose of doing this bank rec is to know what kind of journal entries we need to make. So let's go ahead and make our journal entries, and we'll just take them one by one. The first one is record the EFT deposit. Okay, so you will notice here the books did not know about this EFT deposit until, right, they didn't know about this until they saw the bank statement. Remember the bank statement over here says, hey, I want to let you know you got a $600 EFT, electronic funds transfer. So let's go ahead and make that entry. Come over here, and we're going to make an entry to, obviously, cash, because we're getting money. So we will debit cash, right? And we're going to credit rent revenue. Why rent revenue? Because it tells you what it is, right? It says right here, EFT $600, and it says electronic funds transfer coming in. Then you come over here to additional information because it hasn't told you yet what it's for. It says the EFT deposit was a rent receipt of monthly rent. The EFT debit, the payment out, was an insurance payment. So we'll remember this here in a minute. So rent revenue, and if you look here at your recon, it'll tell you EFT, collection of rent, 600. So we put 600 here. We are crediting rent revenue because we've actually collected rent revenue. And that concludes our recording of the EFT deposit. Now let's go to the record the bank collection of notes receivable. Okay, well, right off the bat here, when you're talking about collecting, right? You're collecting, bank collection of note receivable. Note receivable is something that is owed to us. Receivables are assets to us, so they're owed to us. So basically, what we have to do is come over here and go, okay, what have we collected? Bank collection of note receivable 1,300. Well, we know it's going to be 1,300. Okay. The only question is, what do we book? Well, obviously, if we're recording a bank collection, so they collected it on our behalf, we are now adjusting cash upwards. And as we collect cash from this person that we loaned money to, the note receivable slowly goes down. So this is an asset, right, that we're owed, and it has a normal debit balance. But as we collect cash, basically the cash replaces the note receivable little by little until magic day arrives and note receivable on the balance sheet is zero because it started with, let's say, 13,000, and every single month we take 1,300 out, 1,300 out, 1,300 out until basically the note receivable works its way all the way down to zero. So this is the entry you make for the collection of the note receivable. Now record the correction for check number 3150. Now you will remember when we look here, this is the one where 1350, let me put the checkbook up because the checkbook has the actual check number. And we'll put them right next to each other as much as we can. Remember the books recorded it at 1530, but the truth, right, it says that this is what was recorded incorrectly. 1350 is what the check really had, and it's what the check really is. This is just a human mistake. We need to make an adjustment for that. Keep in mind if 1530, let's look carefully at what was booked, okay? Let's look carefully at what was booked when this was originally made, when this entry was originally made. So 1530, okay, we thought we were going to pay 1530. So let's come over here. We thought we were going to make this entry. Cash. It's hard to write with the mouse. But that's not bad. We thought we were going to make, and we thought this is what was happening, right? And then what we were doing is we were paying this on account. If you look carefully at the problem, it says, additional information, the correct amount of check number, uh, it was a payment on account. On account means it can't be accounts receivable because we're paying. Accounts receivable is what we collect towards us. A payment on account is accounts payable. So we thought, hey, we're going to credit cash for 1530 and the check is 1530. And we thought, hey, when we do this, this will be our entry. It'll be accounts payable 1530. Hard to write with a mouse. Okay, so this is the entry as we made it. And then the bank statement told us, no, 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 no. We're right, you're wrong. This was booked incorrectly. This should have been 1350. Okay, this should have been 1350. So if this should have been 1350, that means this cash was lowered too much, right? And accounts payable was lowered too much. Because remember, this lowers accounts payable is a liability, has a normal credit balance, so it's slowly debits slowly eat away at it, and cash. So basically, our cash is understated. We took too much cash out, and we lowered accounts payable too much. The reason I'm going through this whole diatribe is if we discover this error, right? So we're back to here. If we discover this error, and let's get rid of this. Oop. Don't want to print anything, thank you. Going back up to the statement, okay? If we discover this error, right, this means this $180, right, is in here, is in this 1530. So if we're going to undo what we did, which we originally thought, hey, 1530 cash, 1530 accounts payable because it's a payment on account, that means we need to reverse this, okay? We need to reverse this for the difference. If we're going to reverse this for the difference, it means we're going to debit cash. We're going to try to fix this mess, right? We're going to debit cash for 180, okay? And we're going to credit accounts payable. We're going to restore this portion of accounts payable to what it should be by putting the 180 back, okay? So we thought this is the entry that we were going to make and leave alone because we thought it was right. The bank statement said, no, 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 it's 1350, you're wrong. So now both these entries are too high. The way you fix this mess, you know, of dropping cash too much and dropping payables too much, is you invert it. Notice it's inverted. Now we're putting 180 back into cash and we're putting 180 back into accounts payable. So if you were to run a T account, the T account would show a debit for 1530, and then a credit for 180 to net out to 1350, which is the same as making their entry right in the first place. And cash would have 1530 out with the 180 put back in, which equals 1350, which is what you should have done in the first place. So just reverse the entry off in the books if you're trying to fix a book error. Let's come over here. We'll go down to the bottom. And this, like I said, it's not too difficult because what you do, you're basically, you had a mistake, so you're putting the cash back. And the cash back is 180. It's a credit of 180. Again, to remind you, 180 is right here, correction of book error. That's what they're asking you to fix. And remember from our analysis a minute ago, it's accounts payable. Okay, so this debit to cash will fix this entry. It'll fix this wrong entry so that it's truly 1350. And this entry to accounts payable will fix this to what it should have been. All of these entries together equal having done this right and having cash of 1350 and accounts payable of 1350. If we had done this, when you look at the net effect of this, it's making the entry correctly. Okay, and you come down here, you got cash, you got accounts payable, and that concludes the correction of that. Let's go to the EFT debit. Okay, the EFT debit, if you remember correctly here, on other data, it says, hey, I'm letting you know that the EFT debit was a monthly insurance payment. So you're paying for insurance. Going back to the bank statement, you will notice that it is EFT of 442. Okay, to work this and make sure you got it right. Oops, I'm sorry, I pulled the wrong, nope, I got the right amount. If I can ever get on the right number, here we go, 442. EFT payment of insurance. You see the 442. So it's time to book some EFT payment of insurance. And the bank statement's telling us, hey, we drafted 442 to pay for this insurance. If we drafted it, that means our cash is going down, right? And it's 442. And we're recognizing some insurance expense. Even though we didn't write a check for this, the statement, the bank statement is telling us, hey, you need to book some insurance expense because we took it out of here. We took it out of EFT payment of insurance. So it's letting you know the books don't know anything about this. You're having to make this entry to debit insurance expense, which means expenses go up, and cash at 442 goes down because you're actually paying insurance expense. You just happen to be notified of it when it's being paid through the bank statement. Now let's look at the unauthorized check that was returned by the bank. Okay, this is the one that, hey, we're letting you know that this person paid on account, right? If you look here carefully, it'll show the unauthorized signature check was received from a customer and returned by the bank unpaid. So again, this is a check just like an NSF check in that it's no good. What this means is that with this check amount, which you come up here and it tells you what it is, unauthorized signature check. Okay, that means you're going to have 435 debit, 435 credit. Cash that you thought you had, you don't have, so you have to lower the cash account. So the only real question is, what do you debit? Well, this payment was made to you on account. In other words, they were paying you for an accounts receivable. You had an accounts receivable on your book, and then you got paid. And when you got paid, you debited cash and you credited the accounts receivable. Well, now you're getting the bad news that, hey, this cash was no good. This signature check was returned because it had a bad signature or no signature. So now you don't get the benefit of that cash. It's dropping by 435. And in addition to that, the receivable needs to be put back on the books. A receivable that you thought you had collected, right, with the opposite of this entry, debiting 435 and crediting accounts receivable, is wrong. This entry, as it was made originally, a credit to accounts receivable and a debit to cash, got cash, debit, worked an accounts receivable down, credit, is wrong. Okay, when it came through, you're going to have to reverse. Again, you notice the pattern of reversing the original entry. We have to give up the cash because the check is no good, and we have to reestablish the account receivable. And obviously, after we reestablish the account receivable, one of the questions we're going to have is, hey, we show a receivable on the books. Where's our cash? All right, so finally, let's go ahead and book what perhaps might be the easiest thing of all, and that's booking this miscellaneous service charge. Again, if you come over here, you will notice that we've made entries for the EFTs, we've made entries for the unauthorized signature. In other words, that's the bad check for 435 that we made right there. The only thing that's really left is the $25 for a service charge. This should be pretty easy. It's obviously telling you, hey, we took $25 out, so let's put 25 and 25. Notice that once again we can use the bank statement, not the easy one, not the top one, but the one that starts with ending cash balance per the books. We can just kind of check off the amounts, go entry, 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 entry. Now we're doing the service charge. So we'll come down here. What you would like to book, right, is you would like to book like bank service charge. So you're looking here, you want bank service charge, bank service charge, bank service charge. You'll notice there is nothing called bank service charge. So since you have nothing that really captures it, just call it miscellaneous expense. This company, obviously, based on the choices they gave you, they don't think it's going to be that much, so they just put it in miscellaneous. And then you credit cash for $25. So you're out the cash, the bank statement's telling you that, and you have to record some miscellaneous expense. This concludes the entries that you make. The really important thing, I think, to take away from here is realizing that what you have to do is make an entry for everything that's an addition or a subtraction on the bank reconciliation that begins with the book's version of ending cash. That concludes our entries. made to account for the additions and subtractions of the bank rec, the book bank recs that begins with the cash books. I hope you found this useful.